I'll share the process of funding with you. A lot of people have this question. This is a common question: how to raise funds through StartupLanes, and a lot of people miss out reading various different points. So here I am creating a video for you so that you can understand the entire process. Okay. So first of all, let me tell you how this filtration works. How do we find out whether a startup should be considered for raising funds or to accept that startup in our angel network? What do we look for? Okay. Alright, so let's start. Most important thing that we look at is your revenue, because there are a lot of things that comes into picture and it proves a lot of points when you have the revenue. So if you have the revenue, that proves that you have already developed a product, your customer has accepted that product, there is a market for that product, no matter whether you are making profits or you are making loss, right? So revenue is most important factor that we look at a particular startup. Then we look at what kind of size, how big is the market. The market has to be massive, right? Why it has to be massive? Because if we are investing in a particular startup, there should be scope of growing further. If the market is small, then you will not be having that scope to grow further, right? So market has to be really big. And then the third point which is important is there any VC funded startup in that particular same segment, right? I'll tell you why. Because startups are supposed to disrupt. There should be, if there is a VC funded startup in the same segment, then it becomes very easy for us to get into that. It proves that this product particularly is accepted in the market, VCs are happy about it, and that proves a point, right? But you need to check how you are better, and this better should be in terms of disruption. In case you are not able to disrupt the market leader, then it becomes a problem for us. So I'll tell you how you can disrupt a market leader. If you are having a homogeneous product or a service which is offered by the market leader, right? I'll give you an example of noodles. Okay. So noodles is a very common product, and in the market you have lot of companies available. Suppose your startup start making a product which is similar to the product offered by the number one product in the market, right? They are selling a packet of that particular ready to cook 2 minutes noodle for say 14 rupees. And if you are able to get the same taste, same time of preparation, and almost similar ingredients, that means the output is same and the customer is deriving the same value out of it, then in case you are able to sell it at a lower price, you will be able to disrupt, right? Disruption happens generally in two ways: price and convenience. There are two types of disruption, in fact: new market and low end, right? New market is generally, when you invent something, you create a completely new market, which is not a daily basis case. So most common one is the low end disruption, in which two types are there. Either you disrupt in terms of pricing, that means product has to be homogeneous just like the market leader's product, yet your prices should be low, or you are able to give more convenience at the same prices, right? Or even more prices. Book My Show is a very classic example of charging for the convenience, because the movie tickets you were getting earlier also, but you have to stand in queues. In older days, there was no confirmation of seats. Book My Show disrupted that market through convenience. They charged a convenience fee and people are happy to pay it, right? And generally, what our expectation is that you should be able to disrupt in terms of price and convenience both. If you are able to disrupt in terms of price and convenience and rest other factors are good, awesome, right? So we check the TAM, SAM and SOM. TAM is the total addressable market, then serviceable available market, SAM, and SOM, serviceable obtainable market. We check all these three factors
And besides that, after checking that whether the market size is good, then we check who are your competitors, right? So you should be having a competitive advantage over your competitors. If your competitors are having better advantage, say they are able to sell at a lower price, then it's not a good proposition for funding. You should have the better price and better convenience over your competitors. You should win your customers, right? Then we check how are you acquiring customers and what is your number of customers. If you are acquiring customers digitally, awesome. If you are acquiring customer in a mode where you have to send quotations, then you have to send somebody to their office, then it's not a very good funding proposition for us. If it is digital acquisition of the customers, that means a seamless process, awesome, amazing, that's very good for us. Thereafter we have to check whether your vision is big or not, whether you want to take this company to a larger scale at a very high level, or you just want to take the company and stay hand to mouth. So if the larger vision is there, definitely we'll be supporting you in raising funds. And thereafter we check few more factors which are also important. That is, we check whether or not this company can become a unicorn in next 5 to 7 years, and if it is possible, if you are able to have that kind of moat, and the business model is very good, then definitely if it can become a unicorn. There is a revenues to valuation multiple that we check. Suppose if your revenue multiple is 4x, then what we do is you need to have 2000 crore top line to have a 8000 crore valuation, right, multiplied by 4. So we check whether in next 5 years your revenue could be 2000 crores or not if the multiple is 4. This multiple differs from startup to startup, right? So if you can become a unicorn, awesome, this is what we are looking for. Then the business model, if the business model is asset light, amazing. If the business model requires investment to go into plant, machinery, lot of fixed assets, building, we don't want to support that, because ultimately that is not a startup is supposed to do. Thereafter we check how is your applicability of the fund, where are you going to deploy these funds. In case you are looking to deploy these funds for acquiring the customers, awesome. So 85, there is a rule, 85-15 rule that we follow. 85% of the funding should go for acquiring customers. If you are spending money to hire staff, buy more products, or buy computers or anything, that should be limited to 15%. Majority of your funding money should go for acquiring customers. Then from the revenue of the customer you can buy anything, we don't have any issues, but the funding money you should be utilizing for acquiring customers. Thereafter, once you when we see all these factors, we also check the team. If the founders, we try to avoid a single founder, right? So if there are at least two co-founders, awesome. If the founders carry experience and expertise and education related to the domain which they are working, that also adds up, right? So that's very much important. If you have that experience, expertise and education related to that particular domain, then we'll be definitely trying to support and fund that particular startup. Industry growth rate, if the industry itself is not growing, then it's not a very good proposition for us. But if the industry is also growing, then that shows that the proposition is good, industry is growing. And thereafter we check the profitability, not the profit. You may have losses, no problem, right? And generally startups have losses because they keep on expanding. So you are scaling up, you have losses, no problem, and that is the reason why you will be requiring fund to cover up your burn rate. But your profitability should be good. If you have 1 or 2% margin, not a very good deal for us, unless you are a fintech or in an industry wherein the volumes are massive. But in case you are into an industry where there is a heavy goods transfer, you need to operate logistics, or your risk has to be large, risk has to be taken, then that becomes a problem if you have thin margins. Generally in services, if you have a bundled product, your margin should be good, 20%, 40%, up to 70%. More the margin profitability is, then it is good. So all these factors combined we check, And the process to apply is, first of all, identify which stage you are falling. We have created 4 stages, incubation, acceleration, growth angel, and the VC funding stage. So in case your revenue is A to B, that means as per our guidelines which is mentioned at our website, you check that table. If it is A to B, that means below that threshold, then you fall into incubation, right? You'll go to incubation. You need to understand the nitty-gritties of incubation. We'll be helping you, supporting you. We'll take some equity and we'll support you and then take you for funding. Second stage is acceleration, again the B2C level, not business to consumer. That means from one point to another point of revenue, you can check that table which is already mentioned. So if you fall into acceleration, we'll help you out in growing faster and support you, raise funds, go to another angel network, then VCs. Third stage is growth angel, where we don't take any equity. In incubation and acceleration, we take some equity. In growth angel, we don't take any equity. So in that growth angel, you just have to pay the success fee and lead and syndication fee, and that growth angel is the stage where your revenue is comparatively higher in comparison to the last 2 stages. And if you fall into that category, then you have to check something which is very much important. You will be needing few documents: pitch deck, valuation, projections, and a research report that we prepare for you. Valuation has to be, we prepare fair share method of valuation. DCF we don't accept generally. And in case you have not raised funds using the same documents, if you are coming to raise funds for the first time, then probably we need to build all the documents mandatorily from our vendors, right? So there's a pitch deck bundle we have created, including pitch deck, valuation, projection, research report. You have to go through that particular pitch deck bundle you have to take, and thereafter, if we approve a startup, this approval process, I'm telling you how this works. So generally we are receiving 1200 to 1600 applications on daily basis, so that's a massive volume that we receive. Not every startup is fundable, so it takes time for our team to respond back and take you to the pitching session. We have created a fast track method. I can take 1 call a day, and if you want a faster method, you can book a call. You can go to StartupLanes website. In the contact, you can select book a call with the CEO. This is the straightforward direct method, faster one. What happens is, system will give you a time and a day where the call will be directly with me. Now this will save a lot of time because of my experience. By God's grace, I have been advising startups globally, and my ranking has grown up to 4th in the world as a venture cap, ranked 4th in consulting for startups and VCs. So I have got that kind of experience to analyze your startup in 20-25 minutes, right? And I can immediately tell you whether we could be able to select you or we may not go ahead. And in case you do that, please understand that it is very difficult for us to say no, but we have to, because ultimately if we select you, we have to make sure that you get funded. It's no point taking a startup which cannot be funded, right? So 124 startups till now have demo date. They have, all of them got funding. Startups like Burger Singh, the ticket size was 30 crore. Startups like Zapfresh, their revenue was 72 crores. Startups like Kitchen Center, their revenue was 20 crores. All of these startups, good startups, have passed through our system successfully, right? So we want to take only a startup that can be funded. Our success rate is 100%, and that is why please do not mind if we are not able to select you at that particular moment. In the call, you will be learning a lot of things, this I can assure you, and I will be also telling you the right way, how you can come back later with the funding, right? So that's most important. If you want a fast track method, book a call. And let me also tell that this call booking is not a commercialized system. We use a separate account which is used for charitable purpose. So your 1500 rupees is going for good work, right? This is just to make sure that only filtered people calls us, not everybody. If everybody start calling, then it becomes difficult, right? So this is the method, this is the way we can help you faster, in a quicker way. Book a call, talk to me, I will analyze the startup and tell you right away how early we can take it, or whether we can take it or not. And that is how this goes on. I will be telling you post selection entire process. So what happens is, once we select a particular, approve a particular startup, the first step that starts is called DD, due diligence, right? We are not like others. So instead of doing the DD at end, we do the DD before taking the startup. Why? Because our success rate is 100%. So why to waste time? Let us do the DD. Initially, we do that DD. That means we will be checking your financial documents, bank statement, provisional balance sheet, your reviews on social media, mostly lot of things, your legal background, whatever we can do, we will be checking that, and there is a fee attached to it, nominal 10,000 rupees adjustable fee. So that DD we do, and after DD, if you don't have previous funding using the document, then you have to go for the pitch deck bundle. Thereafter, by the time this pitch deck bundle gets ready, we will give you a date for the demo day. In the demo day, you have to be present. It will be an online Zoom meeting mode, and investors will be invited. You will be presenting in the demo day. Post the demo day, we float in the investors with a form, they commit the amount, and then we start connecting them one-on-one with you. Once the connections have been done, one-on-one call has been done, investors sign up a term sheet, shareholders agreement, and thereafter the funding comes. In between, there is a mandatory and important process of funding mandate, right? I have created a separate video for it. So startups who are selected, we can share that video link with them so that they can understand about the mandate, which is very much important process. And once the mandate is signed, then only we take that startup further. So first the DD, if the DD is approved from our side, if we find out that there is no discrepancy, then we take the startup to the next level. That means the mandate sign up. And once it is done, then we will be helping you throughout life in raising funds, even after the IPO. It's a long run relationship, and I always prefer to meet the founders before approving a startup. So in case you are living in and around Goa, or maybe if I have plans to visit your city, definitely we have to meet before approving your startup, because it's a long-term relationship, as well as we are responsible to our investors to give them the right kind of startups and understand the founders well before we present any opportunity in front of our investors. So this is the entire way from application process to funding. All the documents I have shared. Just to conclude in a short, first thing is you have to self-evaluate yourself, then categorize as per our table whether you are getting into incubation, acceleration. All the details are mentioned about equity and the revenue. In case all these things are acceptable to you, make sure you read a standard founders agreement before you fill up the form for application. That is there at our website, so that you understand what will be the use of the data that you provide, how we'll be acting and all that. Thereafter, the important process comes is the call with me. So you have to book a call, and or wait for our team to contact you. It may take some time. If you want it faster, you can book a call, and like I said, your money of call booking is going for the charitable purposes, so that way you are contributing to the society as well. Then once you book this call, you'll be having a one-on-one call with me. There I will be helping you understand the business model and the further things, and I'll be evaluating the startup proposal whether we can take it or not. Once it is approved, we go for the DD, due diligence done, then we have to go for pitch deck bundle. In case you don't have a pitch deck bundle set which has raised funds, right? So that is important. If you have raised funds in the past, then we can use the existing documents. If not, if it is the first time, then you have to mandatorily go through this process because we don't want to take any chance. And thereafter, once it is done, we'll take you, after the mandate is signed, we'll take you to the demo day. In the demo day, you get commitments, then term sheet, shareholders agreement, investors will transfer the funds, done. And then you have to announce the funding and go for the next round of funding, and this process continues. First you raise angel funds, then we will take you to the other angel networks, then we will take you to the venture capitalists, then we'll take you to private equity, and then IPO, and the entire process works like this. Thank you so much. I'm Shishir Gupta, founder and CEO of StartupLanes. See you again.